Hello everyone and welcome back to ARCHIP News, where we break down what's happening in the world of crypto. Today we're recapping a packed year of headlines and we'll be exploring how the biggest developments this year are setting the stage for digital assets in 2026. Let's dive right in. First off, 2025 was a year full of big promises, but not all of them were kept. Early in the year, the US government announced plans for a national strategic Bitcoin reserve, creating huge excitement. Yet despite the ambitious messaging, the government never actually bought Bitcoin with taxpayer money. Still, by the end of 2025, the US held around 328,000 BTC, mostly from seizures rather than intentional accumulation. Another idea, bit bonds, briefly gained attention but never got off the ground, although New Hampshire did approve a Bitcoin-backed municipal bond. It is possible that more countries will explore digital assets reserves in 2026, but government decision-making tends to move slowly. Now, companies, not governments, seem to have gotten this message about the strategic relevance of Bitcoin. Corporate Bitcoin adoption surged significantly this year. Over 100 digital asset treasury companies raised around $45 billion for Bitcoin purchases in 2025 alone, boosting their combined holdings from 450,000 BTC to more than 800,000 BTC. Together with ETFs and other funds, public companies now hold about 2.5 million Bitcoin, roughly 12.8% of the supply. And institutional holdings increased by 35.5% in less than 12 months, which goes to show that the long-awaited institutionalization of this asset class is finally happening. And this institutional wave shows no signs of stopping just yet. Major players like Bank of America will allow clients to allocate part of their portfolios to crypto starting in January 2026. This means about 16,000 advisors will then be free to recommend BTC to millions of Bank of America clients worldwide. And yes, even longtime skeptic Vanguard just caved in and opened their door to crypto ETFs on their platform. While crypto adoption among institutional investors is remarkable, the adoption numbers of stablecoins are even more impressive. In 2025, and after filtering out artificial or automated activity, stablecoins processed approximately $9 trillion in value, an 87% jump from the year before, surpassing half of Visa's payment volume and dwarfing that of PayPal by far. The appeal of stablecoin is clear: fast global settlement, 24/7 availability, and very low cost. Companies like Stripe and even PayPal itself expanded their stablecoin integrations. Beyond this adoption, stablecoins also carry macroeconomic weight. The two biggest stablecoin issuers, Tether and Circle together, now hold roughly $180 billion in US Treasury bills, which amounts to about 3% of the entire T-bill market. Only mid-sized sovereigns hold comparable amounts. And speaking of Circle, the company was responsible for another milestone within stablecoins, which was their IPO happening in June 2025. And on the first day of public trading, Circle's stock surged from its $31 IPO price to close to $83 US. The debut sparked comparisons to a ChatGPT moment for stablecoins. The strong listing has also encouraged other crypto-native companies to consider going public in 2026. Rumored candidates include Kraken, Consensus, Chainalysis, FalconX, or even BitGo. Outside the tokenization of fiat currencies, which the stablecoin trend represents, the value of tokenized assets grew from 15 to more than $35 billion US, driven mostly by private credit and tokenized US treasuries. Traditional financial institutions, including BlackRock, are now actively issuing on-chain funds and using blockchain infrastructure for settlement and liquidity. This trend is expected to accelerate in 2026. Stablecoins will serve as the on-chain cash leg, and decentralized markets will increasingly provide liquidity for a broadening universe of tokenized assets. Now, most of the adoption in tokenization happened because of advancements in global regulation. The US improved stablecoin legislation, Europe completed the rollout of MiCA, and countries in Asia and the Middle East continued building innovation-friendly frameworks. Across the board, requirements around custody, reserves, transparency, and licensing increased, albeit in a very fragmented way across many jurisdictions. Finally, prediction markets enjoyed a breakout year. After booming during the 2024 US election, many expected their activity to drop off, but it didn't. In November 2025 alone, 1 year later, prediction markets processed $13 billion, more than triple the previous peak last year. Platforms like Polymarket have become surprisingly accurate forecasting tools, and regulatory progress, including a major investment from reputable traditional exchange infrastructure providers, signals that prediction markets are moving into financial mainstream. Overall, 2025 showed that while governments are still slow to act, institutions, fintech companies, and blockchain-based markets are rapidly integrating crypto at a structural level. These and other developments will surely carry on into 2026 and beyond. So, what are your highlights from the year 2025? And what do you think will be the most relevant drivers in digital assets in 2026? Let us know in the comments. Until next time, and don't forget to like, subscribe, and follow ARCHIP for more weekly insights into the future of crypto.